Joining us today to discuss how to buy an accounting practice is Daniel Talbott. Daniel is the owner of Right Exit, a firm dedicated to helping owners of accounting firms navigate their exits. Excited to have his unique perspective on the M&A landscape and what makes a successful acquisition in the accounting space. Daniel, welcome.
Daniel, really appreciate you coming on today and excited to have you here. I kind of want to jump right into it. How did you get into selling accounting practices?
Yeah, man, it was like, following one opportunity to the next, just reading the kind of the writing on the wall. I got into accounting as a second career for me. So I switched careers in my late 20s. Prior to that, I had been in the surety industry, which is the professional polished way of saying I was a bail bondsman. So I ended up taking over a family business and failed. And I wanted to know why I failed. So I went to school for accounting, learned all about taxes and P&Ls and balance sheets, and decided I really wanted to help other business owners. So I always kind of had that advisory mindset that I wanted to lead with getting into the accounting industry. But I started with tax. So I started with tax planning for businesses. And then that kind of dovetailed into what would become sort of like fractional CFO, like the early stages of fractional CFO offerings. Early in my accounting career, within the first couple of years, I got a job offer by a VC-backed virtual accounting firm in San Francisco. So I moved out to San Francisco. I took over as head of sales and got to lead the growth of the sales team and building that company from one employee to 100, from just a handful of clients to almost 3,000. And so I got to see the hyper growth of a firm condensed into a 2-year period of time. So it gave me a rare level of insight that I'm so appreciative of getting, where I can look at a firm, like typical firms when they grow, they go through these shifts over decades. We went through it over months. We had to launch pods 3 months after we had just added client success advisors. So it's like, everything was hyper condensed. So it put me in a really good spot to be able to advise other accounting firms, even while I was working as in sales, and then ultimately jumped over to another firm where I led as the head of corporate tax. We were only doing S corps, so it was like always small business serving. When I went out on my own, I was kind of doing two things. So I was still supporting clients, but I was advising firm owners as well, based on some of the things I had learned. And that advisory bug's like what was always interesting to me. I wanted to help people do better. And so I really leaned into that advisory fractional CFO type space. I'm still kind of helping on both sides. And I was trying to find a niche, and the niche was just eluding me. I mean, I tried automotive businesses, I tried construction businesses, nothing really clicked until I stumbled into mergers and acquisitions. I decided to buy an accounting firm to support some growth. And so I joined a business buying community, and I found a ton of people who were buying businesses that didn't know how to read financials. And most of them wanted to buy accounting firms, but come back around to that. But because so many wanted to buy accounting firms, and because I had a lot of experience in accounting and had consulted accounting firms, I became kind of a natural support for buyers, whether we were going to try to partner on certain deals or they were bringing me in as a fraction. So I ended up adding a support as a service of my accounting firm. Did that for about 6 months, a year, coming up on a year. And that was when I had someone reach out and say, somebody who I knew in my network, and they said, "Hey, Daniel, you're working with all these buyers. I know a seller. Can you help them find a good buyer for their firm?" And I was like, "Yeah, absolutely." So that was my first engagement as a sell side broker. And I got bit by the bug. I fell in love with it. I became addicted to doing the deals on the sell side, and I ended up shutting down my bookkeeping and tax and CFO services and went all in on it. We did that for about a year, and then I rebranded as Right Exit beginning of last year, just to really double down on the brand and the mission of helping firm owners specifically, who I have so much respect for and love for serving, to help them find the right steward for their firm, to find the right buyer for the right price at the right time.
And to that point, what does Right Exit's clients look like?
Yeah, so we specialize in what I refer to as upper Main Street or lower middle market accounting firms. And we talked about this right before we started recording, but when you think like big picture, people look at Main Street like 0 to 5 million, and then lower middle markets like somewhere between 5 and 10 to like 15 or 20, something like that. So when we look at the market segment, what we do is we consider the top 100 firm as like the large market. Like that's where the investment bankers are operating. But a large firm, I mean, other than the big four, $100 million in revenue is enormous in accounting. So the vast majority of firms are doing under $1 million. So that means that our Main Street is like 0 to $1 million. Upper Main Street, lower middle market for us is like 1 to 5. Lower middle market's like 5 to 10. And then you start to get to like middle market once you're above 10 to 15 million in enterprise value. And so I'm using these terms not to just define the markets, but to define the process in which we go to market with firms. So a Main Street firm, sub 1 million in revenue, that's like a book of business. You're typically going to just be listed up on a listing platform like a Biz Buy Sell, or, there's certain niche brokers who are in my space and they are listing brokers. That's what they do. They have, they'll stick you up with the other 50 to 100 firms that they're working with, and then they solicit buyers that way. Once you get to that upper Main Street, lower middle market space, we may still put prices on it, but we're starting to move towards deal structuring. We're starting to move towards an auction process. And that's where firm owners, most accountants have encountered an M&A advisor or an investment banker at some point in their career. So once you've gotten to that level of maturity in your firm where you're doing 3 to 5 million in revenue, your firm probably deserves a more sophisticated go-to-market process by an M&A advisor than, if you were just a sub $1 million book of business. And so that's where we identified that hole in the market. There were these mature firms with sophisticated owners who had some insight into the M&A or investment banking process, but their only options were either kind of a more real estate style listing broker experience, or try to try to entice a boutique investment banker to come so far down market and ultimately have to pay a huge retainer. So we designed our model to fit right in between so that we can offer a more streamlined process than investment banking, but a more sophisticated process than your typical business brokerage.
Gotcha. And then you're breaking up these different segments by enterprise value?
Yeah, and so the reason for that is the SBA loans. So if the business is worth less than 5 million, then the largest percentage of the buyers out there are going to be SBA buyers. So we kind of index our go-to-market process around the largest pool of buyers. If the enterprise value is going to be over 5 million, then it's a little bit different motion because now we're talking to private equity or family office backed platforms. So the selling motion just changes a little bit.
And then when we talk about accounting practices, I know there's like pretty broad here, bookkeepers, full CPAs, advisory firms. Are you selling all these type of businesses, or when I hear accounting practices, what should I be thinking of?
Yeah, so I really specialize in CAS. So that's client advisory services. And client advisory services is kind of a more advisory focused accounting practice where they're offering services anywhere from bookkeeping all the way through fractional CFO support. Tax becomes an add-on for these types of firms. A lot of them are virtual. And so I really specialize in the CAS accounting practices because that's an area that has been misunderstood by some of the legacy accounting brokers in the space. In fact, one of my favorite deal stories is I took a firm to market that was identical to another firm on the other side of the country at the exact same time. And I'll run through some numbers. Both firms were doing less than 1.5 million in revenue. Mine was doing 1.1, the other one was like 1.3. Mine was in Colorado, the other one was in Tennessee. The profit margins were about the same. Firms was a little bit higher because all of the support staff were offshore, which could be a pro or con depending on who you're talking to. The other firm had mostly US staff, but still very healthy margins. So my firm was doing 700, theirs was like 5 or 6, somewhere around there. That firm sold for $1.5 million at the sale price, the one in Tennessee, the one we were competing against. I sold the firm I was representing at the exact same time for $3.1 million, double the sale price, identical firm, arguably with more risk in the firm that I was working with. And the reason why was because the other firm sold to a traditional firm buyer, somebody who had been in the space for a long time. It was that's their ecosystem. I sold to somebody who was more familiar with tech and recurring revenue models and, cloud-based businesses. And, I'm not saying that you can get a SaaS valuation for an accounting firm, but when your firm is fully recurring revenue, when you have fully remote or remote enabled firm staff and client engagements, it's just a different game than selling a traditional firm. So that's my specialty. I specialize in that area. But I mean, I love accounting firm owners, and there's so many in between, from the traditional firms that are still doing things with pen and paper to tech-enabled traditional firms to fully virtual cast firms, people that need help on all levels. So, we will dip into some of the other areas of the industry. I'll admit I struggle with like audit firms. There just aren't a ton of buyers for audit firms. Now I know there's probably some other accounting business broker out there that's going to hear that and laugh because they have the easiest time selling them. But, I just don't have the relationships with the audit firm buyers. So, we'll still take it on. I know some good private equity groups in the space, but that's not my bread and butter.
To that point, you're kind of talking about who's buying accounting firms right now. It seems like there's a wide spectrum of, you have these tech buyers, you have private equities, you have strategics. So who are buying accounting firms right now?
Yeah. So, I mean, you have individuals who are in the accounting industry. Maybe they're CPAs, maybe they're licensed or credentialed in some respect. They aren't in the partner track, and they know they have 10 years before they can be, but they're entrepreneurial. So those individuals might want to buy a book of business to be a jumpstart, or maybe they're a little bit better capitalized and they would go after a small firm doing somewhere between 750 and 1.5 million in revenue. You also have small firm owners who are looking for a little boost in growth rather than the constant seesaw of attracting clients and attracting staff and attracting clients and attracting staff. Instead, they'll go out and they'll use the SBA 7A through the expansion loan program to buy a similarly sized firm that they can envelop in and merge those two practices. Then you have larger firms that are tucking in smaller firms. So these are kind of like the self-sponsored roll-ups. They're following the private equity model. It's just to build a big valuable firm that they can sell on their own. Sometimes it's to build up into a platform for PE to come in and buy them out with a multiple arbitrage once they get to that 3 to 5 million in EBITDA. And then you have the whole other world of private equity and family office backed platforms. But accounting is so interesting because there's so many different startups and AI entries into the market that we actually have VCs that are backing platforms now as well, which they have even a different investing thesis than the private equity groups and family offices.
Follow-up question here. Do you need any certification to own an accounting practice? Do you need to be a CPA to buy one of these cast type businesses?
I mean, look, it's a perception thing. And this is one of my favorite questions to get asked, because most accounting firm owners, even cast firm owners, well, if they are CPA, they're going to say that the buyer should be a CPA. The reality is that if a seller got onto a call and it was Mark Cuban on the other side, they're not going to say, no, I'm not going to sell my firm to you because you're not a CPA, right? So it's like, how do you present yourself? How much money do you have in the bank? What's your background? What does your team structure look like? If you're buying a firm from an owner operator, do you have somebody already lined up to step in and take on that senior role, whether it's senior tax or senior accounting? If you've got your I's dotted and T's crossed, you can buy a firm without being licensed, but you have to do your homework. You have to do some preparation.
So it's sort of similar, if I'm pulling this out, as like an HVAC business is another hot industry where you have to be in many places a mechanical contractor to own an HVAC business or rely on somebody else's license to run the business. So there's some parallels there with accounting, if I understand correctly.
Yes and no. So CAS accounting in particular, we're talking about bookkeeping through like financial statement prep, advisory, maybe some tax prep. None of those services require a license. Now, I know California has a tax prep license you have to get. So like there's some state-based nuances there, but the CPA license itself is only required if you're doing audit. So only if you're attesting to the accuracy of financial statements. If you're buying a firm that does not do audit, then you don't have to be licensed to own it. Naming conventions, some impacts, like in Texas, to call yourself an accountant, you have to be a CPA. Pretty much everywhere else, you can call yourself an accountant if you're not a CPA. So look, I mean, there's some hair on it. It's like not the cleanest thing to navigate. But if you're buying a bookkeeping practice or a tax practice, you do not need to be a CPA for compliance purposes.
Why are so many people excited about buying accounting practices right now? The hurdle to actually own these is not as high as I actually anticipated. So it seems like you got recurring revenue. I mean, there's a lot of interesting things about owning these accounting practices.
Well, so actually that's why there's a huge like ROI benefit or potential in buying an accounting firm, especially if you buy a more legacy operated firm. So typically they're going to be underpricing. Maybe they haven't increased their rates in 5 or 10 years. So you can come in and start with incremental 10, 20% rate increases, and you're just not going to churn a ton of clients. Accounting firms are very sticky. So over a relatively short period of time, you can the value of the firm you bought just by increasing pricing. There's also moving to recurring revenue models. So there's a lot of bookkeeping firms out there that are still charging one off, each quarter, each year that they do the books, and they're doing it all at once rather than putting people on a monthly subscription. That's also, I mean, of course, that's going to be very common in tax. Tax is treated like a project, but some of the best firms, the most valuable firms, are selling tax as a service on a monthly recurring model. And that's actually increasing the average tax return. If the average, let's just say average business tax return is $700 or $1,000, but you could put someone on a tax subscription for $150 a month and includes some quarterly tax calculations. Now, instead of $750 or $1,000, you're getting $1,800 for your average business tax return. So it's just small changes that don't scare away clients, but massively increase the value. And then we have the entry of technology, which I mentioned before. A lot of firms, especially traditional firms, and when I say traditional firms, I mean these firms are valued at 0.7 to 1x revenue. Once you make these changes, I mean, the last deal we just closed on one beginning of the month at 2.25 times revenue. I did one last year. The one I mentioned in my deal story, there was 2.56 times revenue. So if you can buy a firm at sub 1 times revenue and then make some of these changes over a couple of years, we're talking a massive increase in the return on your investment. Implementing practice management softwares, implementing some of the new AI driven tools. It's just so right. I mean, I don't know. I guess I could probably go on, but anybody that we're talking to is probably salivating over the accounting industry with just this information alone.
I think, I mean, a lot of areas here, but because there's so many businesses out there and it seems like the demand for even using accounting firms is so high, how should a buyer really think about, should I start my own practice or should I buy one? I think you alluded to it earlier, is like the customers are really sticky. Like that's a huge part of why buying is a good option.
They are really sticky. And so here's the thing about accounting. It's very unlikely that you are both highly technically capable and great at sales. You're probably one or the other. If you're both, you're probably already a firm owner. If you're really skilled in one area or the other, then it's going to be the seesaw effect up until you get to a certain critical mass within your firm. So let's just say you're really highly technically capable. Well, you can go out to other firms that are no longer taking on clients. You could go to bankers, you can go to financial advisors, and you can get referrals from the people that you can reach comfortably, and you can do the work. But once you fill up your time, now you don't have time to go and hire somebody to help you, or you don't have time to go out and develop a new sales channel. So you tend to get stuck. If you're really good at sales and marketing, you could go out and sell a bunch of services, but if you can't deliver the service, you have to just basically sell as much as you can, as fast as you can, and then hire or contract with people to deliver the service and hope that the quality is good enough to stay in business. So launching an accounting firm from the ground up is very difficult, because even if you do one of those paths, one or the other, you still have to fight and scratch and claw your way to about $1 million in revenue before you have enough excess cash to go and hire someone to do the sales or to do the technical that you're weak at.
So really like springboards you to get to that $1 million, and then you can focus on what you're good at.
Yeah, I mean, I've talked to great firm owners, really smart CPA firm owners that it took them 20 years to get to 1.5 million. So you might as well just buy it and start there.
And there's a lot of like different solutions out there to help you acquire these businesses, right? Like the SBA 7A you alluded to. And are you seeing like most of these businesses being bought with these financing loans? Or if it's private equity, obviously they're just doing cash.
Yeah, I mean, so there's a lot of buyers using the SBA 7A program, and it's such an attractive industry that there are banks that have niche teams that they only do these loans, so they understand the financing of an accounting practice inside and out. So we pretty much only work with those niche lenders because our process is so smooth when we work with someone who really understands the industry. Once you get to those, once you exceed the SBA threshold, the 5 million, you can still get funding. I mean, there are plenty of banks out there that love this industry and will do their own mezzanine debt structures, or there's investors out there that are willing to back these deals. The last conference I went to last year, I met two different groups of individual buyers that had VC backing to go out and buy accounting firms. So, they say that money will find a good deal. So if you find a good deal, the money's there.
When you're looking at a prospective new seller to sell their business, I mean, the same thing when a buyer is looking at a new business to buy, what are things they're looking at to determine this is a good deal?
For the sell side?
Yeah, I mean, I would think that the same thing that you're looking at when you're analyzing a prospective seller to take on their engagement, like, is this a good company to sell, are similar things that a buyer would look at when that company's on market. Is this a good deal that I want to buy?
Yeah, so we're looking at client concentration. We want to make sure that, this is like, I'm going to give you kind of an example. It's going to be a little funny, but those firm owners out there that may or may not hear this will laugh because they know it's them. But the majority of like your typical accounting firms, their top 3 to 5 clients are their golf buddies. These are like the biggest business owners in the community, and they're friendly. They're going out for dinners. They're playing golf on the weekends. So concentration risk is enormous. So we ask about that when we're reviewing a seller. I would encourage buyers to look at that as well, because you want to know it. If you buy this firm, are the sellers, 3 to 5 golf buddies going to go somewhere else, or are they going to be willing to stick with you? The other thing that I see with a lot of firms, and I'm going to make a recommendation. I want to preface this. I don't get paid by the company that I'm going to recommend here. But so one of the risks that we see is that a lot of information is just stored in the minds of either the owner operator or in the key accountants, the senior accountants. And that can be a major risk, because you could be coming into this firm as a new owner and be completely blind, because, if one of your accountants leaves, then how much legacy knowledge are they taking with them? So we've actually moved towards a company called Ping Assistant. It's a meeting recorder specifically geared towards accounting firms. And we're actually making it part of our onboarding process that when a client comes on, if they don't have good notes on all their clients, we will have them implement this tool, because it'll go and scrape all their meeting notes and emails to build a client intelligence platform. I want to say it's a major risk that buyers should look out for, but at the end of the day, like, it's going to be in most firms. Like, most firms just aren't going to have their client intelligence and like client relationships well documented. So we're working on fixing that. But as a buyer, you should be mindful of it and structure your deal accordingly.
If I'm reiterating this to understand correctly, number one is client concentration risk, particularly if those clients have let's say, more than formal relationship with the owner of the firm, like you alluded to the golf. And then two, like, processes and notes haven't been really implemented in a transitional way, are two things you look out for.
Yeah. And I mean, some of the firms, luckily these weren't firms that I've been a part of, or deals I've been a part of, but some of the, kind of the sad stories of firms that were bought and ultimately failed within the next year to year and a half were because they didn't have good SOPs. They didn't have good note-taking systems. And there was some client attrition, there was some staff attrition, and the firm ultimately just couldn't sustain because there were too many unknowns that there's just no reasonable way to recover from that. You can't recover from just not knowing who your clients are.
And then I think like there's a key point here where some firms, the relationship is the client to the owner, the selling owner, like you alluded to. And as a buyer, I don't know how you transition that. I mean, there's got to be some structures that you've seen, or how the owner has like stayed on for a little bit of time here, but it seems like that's a really big risk a buyer's taking when they're acquiring a business.
Yeah, so that's the downside to the SBA program, because the SBA, an SBA lender, the SOPs of that program are going to require the seller to move on. The seller can't stay for more than a year. So what we typically see is the seller will stay on for about a year, either as a full employee of the firm or as a significant significant advisory capacity. And then beyond that, they will typically offer some type of a consulting engagement. And what that's to do is that's to facilitate that transition. So facilitating the introduction of those key clients to the new owner, and then still kind of being the point person while the work is being done by someone else, so that when the full handoff finally happens, the client should be a little bit more comfortable with the fact that, okay, so I'm not meeting with the same person anymore, but I know who I'm going to be meeting with now, and my work has been done well for a while. So that helps out a ton. If you have a seller who just wants to get out and like they want to sell and they're going to give you like a month and then they're gone, I'd be really hesitant with that firm, or I would try to buy it at a significant discount, basically looking at the client concentration. drill in as much as you can and then value the firm, just planning on losing that like 10 to 15% of clients that would apply to.
And then if you're talking to a firm, in best case scenario in M&A and business brokering, a business goes to you and I'm willing to sell, but I want to like build my practice up over the next, 18 months or something. Are you instructing these owners to like, hey, I know you're just heavily involved in the sales and these key clients, try to step away a bit so you can show buyers that are coming through. Yes, we might have customer concentration, but their loyalties to the firm.
Yeah, I think this is a lesson for any business brokers or M&A advisors that are maybe listening to this and considering whether they want to focus on an industry niche or not. I've thought multiple times about getting into consulting, but at the end of the day, we sell firms. That's just what we specialize in. That's what our processes are designed for. It doesn't make sense to also launch a consulting firm alongside it. So what we've decided to do is this year we've been partnering with industry, like specific solutions within our industry. So we have a referral partnership with a recruiting firm that specializes in recruiting talent for accounting firms. We have a relationship with a billing and invoicing platform that helps firms move to a 3-tier subscription-based billing model. And we're working on solidifying something with a marketer. We have a few different marketers because there's so many different flavors of marketing, but we're really working on these kind of company to company, like tight relationships where I'm coming on like podcasts and webinars like this one with these founders so we can share these tips and tricks. So when I meet with a seller and they need to take 1 step or 4 steps to reach that valuation, we can plug them in with the right solutions that are with people that are already known and respected in the industry.
And then when it comes time to, I think there's a lot of value in that, what you just said there, that sentence, like focus on what you're good at, and then everything else, there's probably people who specialize in that. When it comes time to sell, like a lot of the other non-accounting firms, traditional businesses, let's call them, are selling off of seller discretionary earnings, EBITDA plus owner's expenses being run through the business. It sounds like you gave 2 reference numbers off of revenue. Are accounting firms bought and sold on different metrics?
Yeah, so accounting firms historically have been valued based on a multiple of revenue because firm owners, so predominantly it was firm owners buying firms for decades. And the way they would look at it is they would say, I want to buy a certain amount of tax revenue, or I want to buy a certain amount of bookkeeping revenue. And they're valuing the acquisition based on the revenue because they know what their efficiency and delivery model looks like, whether it's the same or different. So it becomes like less of a proxy of like SDE becomes less of a proxy of the benefit to the firm that's buying that other firm, I guess. But now that we see more people coming from outside the industry, so entrepreneurs through acquisition, so ETA buyers, private equity groups, family offices, they are bringing their knowledge from other industries to this one, and they're looking at adjusted EBITDA. I tend to use SDE and adjusted EBITDA more interchangeably because we're talking about accountants. So commingling isn't very common, where like in, maybe an HVAC company or, another business, there's gonna be a lot of commingling. There's just not a ton. So my favorite thing to do, I'm going to tell you this, I'm going to expose the industry here. My favorite thing to do is to ask a firm owner if there's any commingling. And they'll be like, no, of course not. I'd be like, do you have any family members on payroll that don't work for the firm? And they're like, yeah, almost every time. Almost every time. So yeah, there are some additional add backs that like move away from like textbook adjusted EBITDA and make it more SDE. But yeah, we kind of use those interchangeably.
What about the nature of the revenue? So like if you look at one of these CAS accounting firms, maybe the portion of their revenue is tax and a portion of their revenue is some sort of subscription, let's say. I'm assuming the subscription revenue versus one-time revenue is going to have a higher multiple effect.
Yeah, so it can. It's interesting because it really just drives who the ideal buyer is for the firm. I have buyers out there who are extremely comfortable with selling bookkeeping services. So they love buying tax firms that do business tax returns because they know they can get it for a lower multiple, or they can pay more of a tax firm multiple, which is right around that 1 to 2 times revenue. And then they know they can come in and immediately upsell bookkeeping services. On the flip side, I know of plenty of firm owners who love tax. So they'll buy bookkeeping firms because they can come in and upsell tax services. There are buyers who will buy tax firms that support individuals because they know they can upsell financial planning or wealth management services, or buyers who will buy business focused accounting firms because they can upsell fractional CFO. So it's like there's this mindset of, yes, each service has a little bit different multiple, but it's really just, again, a proxy of a multiple on their adjusted EBITDA and their margins. Because it's a tax firm is going to have a lower margin than a healthy recurring a bookkeeping firm. Like the actual lifetime value of the client of a bookkeeping firm will be higher than a tax firm. And the lifetime value of a fractional CFO client is going to be higher than bookkeeping or tax typically. So the multiples kind of shake out that way anyway. So I don't want to say like broadly that there's different multiples for different service lines, but audit firms tend to be worth the least in terms of their revenue to sale price, and then tax, and then bookkeeping, and then more sophisticated accounting, and then like your advisory, tax planning, fractional CFO that tend to be really high margin. Those sell for the most.
And it seems like, optically, a lot of these firms are, because of technology is freeing up time and things like that, is these firms are offering a wider set of services when, I guess, maybe if you look 20 years ago, like you had your tax guy, you had your bookkeeper. So the service offering of these firms, if I understand correctly, are like broadening too.
Yeah, it's interesting. I think a lot of most accounting firm owners have been giving advice for free forever. It's just more recently, like within the last 5 to 10 years, that I don't know if it's the market driving this or if it's the professionals, but I think people are generally more willing to pay for advice now than they have been in the past. They're more generally willing to pay for coaching than they have been in the past. And some of your more maverick firm owners are now willing to charge for those services, and the clients are seeing the value and they're paying for it. So, that's just been a big shift in the industry towards these like really high margin advisory services rather than just focusing purely on compliance. And so we're seeing the industry evolve. I did a post not too long ago. I'll probably follow up with another newsletter or something on it, but there was we saw this. I didn't see it. I was too young, and most of us probably were too young. But this happened to stockbrokers. Like you watch, like Wolf of Wall Street, and like these like Boiler Room. Like these like stockbrokers, and they're making trades. But now the trades are all done with technology. So now that entire industry has moved towards advisory. So now your financial planning and wealth management. I think accounting is going to do something very similar, where as technology does more and more of the compliance, the entire profession is going to shift more towards giving advice that's relevant to the client. And that's something that AI still struggles with, luckily, because AI only knows what you tell it. So a person can kind of be a little bit more intuitive.
How are you seeing accounting firms leverage technology to sell more? Because I guess, again, like going back in time, you had X amount of agents. Those agents or staff could handle whatever the number is, 10 companies per agent. Now with technology, maybe that number is 50. So how are accounting firms leveraging technology?
So far, it's been more on the automation side than AI. Just QuickBooks implementing rules where you can tell it to categorize the same transaction that happens every month a certain way. That already enabled bookkeepers to handle more clients. When they implemented a technology within different tax prep softwares where it could extract data from last year's tax return and pre-populate this year's, that saved a significant amount of time. So, these are like fairly basic things that have already significantly changed the industry. Now we're seeing some AI, I don't think that there's like really a front runner. I don't know if there is, then, message me and tell me who they are, but I don't see a front runner like an AI enabled startup that's like really pulling away. It seems like the people who are doing the most with it are like vibe coding their own solutions, where they are, vibe coding process of tracking your open items that you need to get from your clients, and then building an automated follow-ups, and then ingesting that data and then parsing it out in a way that could just be reviewed. That's why VCs getting into this space, honestly, because VCs see an opportunity to come in. They can offshore the majority of the work to countries where there's just lower labor rates, and then eventually implement AI and machine learning to replace those lower paid offshore staff members with technology. And at that point, the only people will be doing quality control. So that seems like that's their play kind of across the board. So it doesn't hurt to borrow from that if you're a firm owner.
Yeah. There's no shortage of technology accounting solutions out there. I feel like every time I go on like Hacker News or something, there's a new AI accounting thing that's out there. For buyers that are entering this due diligence phase of analyzing a company and thinking, does it make sense for me to buy it? Should they be looking at the revenues, the revenue makeup, customer concentration, how long the owner is willing to stay on, and then you throw in technology there as well?
Yeah, I mean, I think so. What I typically tell buyers is I'll ask them, when it comes to determining if this is the right acquisition for you, you have to decide what you want the next 6 to 12 months of your life to look like. So if your dream is to come into an office and sit in front of a scanner for 8 hours a day, then you should buy a traditional firm that's still doing stuff with pen and paper. If your dream is implementing a CRM and moving data in and then teaching a bunch of staff members how to use a CRM and properly take notes, then you should buy that firm that doesn't have a CRM in place. If all of that sounds terrible, you should probably look for a digital firm with no paper files. You should probably look for a firm that already has a CRM. If you don't love drafting SOPs, you should probably find one that already has a practice management software with well-documented pipelines. Just figure out the things that you really don't want to do that would be major hurdles. And find firms that already have some of those things in place so you can do the fun stuff. If you really just want to change the website and market the firm, find a firm that already has great fulfillment in place and really happy clients, and then go make the website pretty and run your ads against it. But, figure out the firm that gives you the lifestyle you want for that 6 to 12 months after you buy it.
I think this is like a key piece that a lot of buyers miss is when they're looking at buying a business, you should almost be looking at, this is like my personal take on it, like businesses with hair on it and where the hairy or problem areas matches well to your skill set. So if the business is terrible at marketing, but you have some sort of like marketing expertise, and like you alluded to, you like marketing, like that should be a positive sign because you're good at marketing. If you add what you're good on to that firm, you'll be able to grow that firm. So I think it's a really interesting piece of how buyers should be looking at transactions. How long does due diligence generally take? I feel like accounting is probably a little bit smoother because they're accountants, like things should be in order.
Yeah, it's actually pretty short typically. I mean, most buyers are fairly sophisticated too because we deal with a lot of firm owners or a lot of accountants who are buying firms. So most don't order quality of earnings. When you do order quality of earnings, tends to go a little bit faster than quality of earnings reports in other industries. So yeah, I'd say, I mean, it's pretty standard though. So we like 4 to 6 weeks of diligence. If it's a little bit bigger firm, then we might break that up into financial diligence and legal diligence just to make sure, all of the various stakeholders are aligned, especially if there's like private equity interest or if there's in-house counsel and things slow down.
And then you alluded to this, we talked about this earlier on, because there's customer concentration risk and there's loyalty to the accountant and staff. After you acquire one of these firms, you want to have some sort of agreement in place with the owner to smooth that transition. I would assume that also extends beyond the owner to the staff. So anything you see that successful business buyers are doing those 90 days post-close to make sure those customer relationships transition smoothly to your new business you just bought?
Yeah, I would budget for or negotiate in some type of retention bonus for your staff. You really want to make sure that they have something incentivizing them to get to that 6 and 12 months or 12 and 18-month periods so that you don't have to deal with client attrition and staff attrition because, finding accounting clients, like we mentioned before, they're sticky. So it can be hard to find accounting clients, but finding accounting staff can be even harder. So you really want to keep your staff. That's like one of the main assets that you're acquiring is the staff relationships. So yeah, budget for or plan to negotiate some retention bonuses and usually break that into 2 parts over 2 periods. So people don't just write it out to get the payday and then quit.
Mm-hmm.
So that's probably a big one. If it's an SBA deal, I would consider trying to get some seller financing in it, make it contingent to, now there's different rules about this. So you have to be careful how you balance this. You used to be able to tie it to retention, but they thought that was too close to an earnout. So now you can't. But get some seller financing in place so the seller has some skin in the game. You could also escrow some percentage of the proceeds against future losses so that you can, cover a difference in valuation after 6 to 12 months, or that could fund replacing a key staff member if the seller said no one's going to leave and then, you end up losing someone. It could be very expensive to pay a recruiter. So consider escrowing some proceeds. If you're not going the SBA route, then earnouts are actually pretty common in accounting firm sales. I try really hard to, like, on behalf of my sellers, to get them the money they need for their next chapter in life, independent of an earnout, if that earnout is related to growth or, increased performance. But if it's just related to preserving what's being sold and cutting back on attrition and, kind of preserving that revenue, preserving the staff relationships, then it's a fairly safe structure for a seller to take on as long as they have a healthy firm.
All right. So you've convinced me to buy an accounting firm. I want you to look into your crystal ball here. How do you see the accounting industry, these CAS firms, evolving over the next 5 to 15 years?
Yeah. So, I mean, there's like this conversation that's happening in the industry around 2030. So it's either like a collective intuition or somebody actually has some inside knowledge, but everyone says that 2030 is the year they're planning for, because that's when they think that this industry is really going to have either gone through this shift or will start shifting. AI is going to be extremely prevalent. Significant technology automations will be prevalent. So if you are a buyer who wants to get a good deal and you're comfortable with technology, buy a traditional firm, because now we're starting to see a chasm between what they're worth. So traditional firms are just worth significantly less than tech-enabled firms. So if you are a technologist, buy a traditional firm, add technology, you'll be in really good shape in 2030 and beyond. If you are not, buy a firm that spend a little bit more, buy a firm that already has some technology in place, because you don't want to be behind the 8 ball over the next couple of years. Because my prediction here is that within maybe 2 or 3 years, the closer we get to 2030, firms that don't have a solid tech stack are going to be nearly unsellable.
Wow. So 4 years away, it's going to change
Yeah.
pretty drastically, it sounds like.
Yeah, I mean, there'll still be laggards out there that'll be running successful traditional firms that can afford to buy other firms. But this private equity money, the family office money, the ETAs, they're all going to move on to tech enabled. So your buyer pool is just going to get cut to a fraction of what it is today if you're not implementing technology. So if you're an accounting firm owner, or an accounting firm owner who is like, AI is going to ruin our industry, I don't want anything to do with it, you should encourage them to sell their firm now.
Makes sense. This has been super enlightening. Where can people find you at if they have like follow-up questions or want to sell their accounting practice with you?
Yeah, so rightexit.com is the best place. You do a free evaluation, or, we're working on this really cool AI-driven exit planning tool. So it'll spit out kind of like these profiles I've mentioned, like all the assessment, everything we've talked about here today. You can get a report that's tailor-made for you. That'll be right on the website here with we're running tests on it now, so it should be within the next couple of weeks. Otherwise, LinkedIn is my go-to platform. So if you search Daniel Talbott, my first and last name, on LinkedIn, you should find me.
Daniel, really appreciate you taking the time to share all your insights. It's been a lot of fun today.
Thanks for having me.